Hello, chart watchers, and welcome to this Wednesday, July 25th Market Watchers Live Show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we are into our third day this trading week. A lot of earnings reports coming out so far. The Dow Jones Industrial Average down 30 points. The S&P 500 up 6. The NASDAQ up 35. And the Russell 2000 lagging once again, down just about 1/3 of 1 point. 10-year Treasury yield pulling back after a stellar advance at the end of last week, beginning of this week. It is down now 2.94%, still well off its earlier lows in July, but still quite a bit off that 3.11% high a couple months ago. Volatility index down a bit, sitting at 12.24. XLE Energy leading the market to the upside today, along with technology. And materials, the weak link, you can see down about 1/3 of 1%. Among some of the big earnings reactions that we're seeing today, HCA Healthcare. HCA, huge move up $9, which is about an 8% rise. Corning, GLW up also about 8-9%. But to the downside, coming up with a little bit of a disappointing outlook, General Motors, GM, down 7.25% today. Erin, the numbers are coming in, a lot of mixed results. And I think, as you said yesterday, the companies that aren't coming in with the good numbers, for the most part, market's not having a whole lot of patience.
Absolutely not. And yes, good morning. What are some of the ones that you're finding especially interesting? I mean, for me, seeing all of the guidance being changed coming out of some, successful or not quite so successful earnings. I mean, it's investors don't seem to like that either. If you're turning down your expectations, even if you've hit those marks.
Yeah, I think for the most part, we're seeing mostly better than expected earnings. And I know that there are some key areas of the market that have been performing pretty well, but obviously there are some, like the automobiles, really struggling with General Motors and also Fiat, both reporting this morning less than expected outlooks going forward. And so that's putting some pressure on the autos, which we will take a look at in just a bit. But I know we have a couple special guests with us today. We've got Bruce and Roman. Welcome, guys.
Thank you. Great to be here. Good morning, Erin and Tom.
Good morning.
Good morning, guys. I'm happy to be here too.
Well, I'll tell you what, we're very excited to have you because I know you started your own show last Friday, Power Charting, and we're going to get everybody here is going to get a little bit of taste, I guess, of what the two of you have conjured up for everybody on Fridays, 3 p.m. Eastern Standard Time. Like I said, your first show was Friday, and you've got those coming up on Fridays, 3 p.m. Eastern Standard in the weeks ahead. Looking forward to those.
Thank you. It's exciting. It's a lot of fun. So we just recorded another one yesterday, and when we get into fall, we will be recording them on the day of the show. So we'll be getting much closer to the date will be getting much closer to the time that the program will air.
Hey, Bruce, I think you should just do a daily show. What do you think?
There you go.
Well, Tom, I want to be just like you when I grow up, but I'm not sure I'm up to a daily show.
You don't want to be like me, trust me.
But thank you for that.
Yeah. Well, both of you hang in there. We're going to bring you back in about 15 minutes or so. So everyone will get a chance to hear a little bit about your show and how you all look at the market. And everybody will get a chance to listen to Roman, who, we haven't had on here on the show before. So that's exciting as well. But Erin, I'll let you take it away for the schedule and the agenda, and we'll get everything started.
All right. So we have Dan Russo from Chaikin Analytics. He will be joining us tomorrow. And on Friday, that's what we were just talking about, power charting. And you'll want to check that out. I will be gone on Monday and Tuesday. So Mary Ellen McGonigal has graciously accepted that position. And so you'll get to hear from her. August is, you're going to give us your August seasonality report, given that it's going to be the last day of the month on Tuesday. And again, don't forget, August 10th and 11th. I can't believe it. It's less than 2 weeks away. Well, 3 weeks away, ChartCon 2018. So don't miss it. Today's schedule, well, we will be starting off with Roman and Bruce followed by our 10 and 10 to 1. And our first symbol will be Apache Corp. Finally, we'll finish it up with a scooter report, give you some interesting information on what's going on with the scooters. All right, Tom, take it away with some technical news and headlines.
All right, sounds good. We have got a lot of stuff going on in the market today. Of course, earnings just dominating the action, but let's first get into one key economic report that came out at 10 o'clock this morning. That was June new home sales. Disappointing to say the least. 631,000 units was the actual number. Market expecting 668,000 units. So pretty big disappointment there. A little more than 5, maybe almost 6% to the downside. Not good action there. 10-year Treasury yield responding a little bit. Money rotating into the defensive Treasury market, and that is sending the yield down a little bit. But the overall trend seems to have reversed. If we do pull back and continue to pull back, I'll be watching this rising 20-day EMA, which is now getting close to 2.9%. When we were declining, you can see how important that 20-day EMA, that declining 20-day EMA was, and how it acted as resistance for the yield. So now we'll see whether or not the tables have turned and the support holds as we pull back. Let's pull up that home construction chart, because this is not a thing of beauty. The home construction index for the 4th straight day taking a pretty big beating. We were just at 820 toward the end of last week, and today hit a low of 741. That is close to a 10% drop in 4 days in the home construction index. I did do a chart in my blog this morning, but let me just stretch this chart out here and give you a little bit of an idea of what the home construction group is looking like. First of all, there was a big breakout at around 725. Going back, you can see a little consolidation over the summer last month. We made a breakout, never looked back, got all the way up to 1,000, a little over 1,000, and now we have been in this steady decline, pulling back. I think on the weekly chart, I'm going to change this to a weekly and maybe go out just a little bit further. But the key so far has been every time we've bounced up to this 20-week moving average in 2018, since things kind of fell apart back in late January, early February, we have not been able to negotiate that 20-week EMA, and we just continue to move lower and lower. And at this point, unless we have a reversal by Friday, it looks like we're going to close at a new weekly low in 2018 on home construction. And I think that 725 area that I showed on the daily chart is also pretty important on the weekly chart. Again, if you wanted to check out my blog article, it comes down to a Fibonacci level. So let's take a look and see on this index. Here we go. So this was the home construction index. And so I was just pointing out how we just keep dropping, keep falling below this 20-week moving average. We haven't been able to negotiate it. If you go back to the beginning of 2016, when we put in a pretty key bottom and then had a huge run up, we went from 450 to 1,000, more than double in less than 2 years. The key retracement levels coming back. The first one was at 793, but the second one is at 728, very close to the breakout level at 725. That's your 50% Fibonacci retracement. I'm waiting to see maybe if we continue to slowly move down, perhaps we'll begin to see the PPO turn higher on this, or the weekly PPO turn higher. Maybe get a positive divergence as we get closer to a key support level and a key Fibonacci retracement level as well. So that's something to at least keep in mind as we go forward. I'm not ready to jump on the home construction group, but I don't think that run to the upside is over. I think we've just had to pull back and consolidate from what was really almost a parabolic rise in 2016 and 2017. Looking at the market today, there's several sectors that are doing pretty well. The XLE, XLK, XLU. Actually, I think there are 6 sectors that are leading and gaining today, but one that's notably weak is financials. The XLF, this is a group that was moving higher with the Treasury yields moving higher, but you can take a look and see overhead resistance has been in this 28 to 28 and a quarter area for the past 4 months. We got up almost to 28 and a quarter yesterday, and right on cue, the sellers have come back in. I think as long as the Treasury yield holds up and holds that rising 20-day moving average that I was showing you earlier, then I would expect that we'll eventually get this breakout in the XLF. And I think it's going to be really important too, because I had done a chart here. Let me pull this up for you. This is the S&P 500 here on the top, and it's getting close to where we were back in January. But notice when we look at the 4 key aggressive sectors, technology is really the only one at this point that still looks strong on a relative basis relative to the S&P. And what we want to see is the market rallying with leadership from these 4 aggressive sectors. Here's technology still looking very good, in my opinion. I'm going to still I'm okay with the consumer discretionary group because we did have a pretty straight move up, and it's okay to consolidate, maybe even go back to a relative support level. So the XLY, I think, is still okay. But industrials and financials are where we really need to start seeing a pickup. And I know a lot of it has to do with the treasury yield declining, topping out earlier in the year. And then it went under, was under some pressure for a while. And that certainly is going to impact the financials. And we've seen that. But now treasury yields are starting to turn back up again. And we're seeing both of these groups, industrials and financials, begin to outperform the S&P 500. I think if the S&P 500 makes this breakout at 2875, which would take out the January high, I want to see all of these groups starting to strengthen on a relative basis. I do not want to see a breakout with the industrials and the financials continuing to underperform. As you can see, as we went into January, we had a pretty good alignment on all 4 of these key indices. But now, as we get close to another breakout here later in the year, I would say only technology looks really strong. I can still make an argument for consumer discretionary, but industrials and financials really need to pick up the pace here. A couple of groups now that are struggling within the consumer discretionary space. First of all, let's pull up the DJ USRP, which is recreational products. Polaris, talk about a stock. I like to look at the fundamentals and then also solid technicals to support the solid fundamentals. Here you've got recreational products falling, off a cliff today. And the main reason is Polaris Industries, PII. The stock is getting hit hard, but the interesting part of this chart is that Polaris beat top line estimates, 1.5 billion. Market was only looking for 1.45 billion. They beat the bottom line by 10%, $1.77. Market only looking for $1.61. And then they raised their revenue and EPS guidance, and the stock's down 13%. So for me, it's not just about the fundamentals and the strong earnings, but I want to see strong reaction technically. Now, PII has not broken down. You can see this double bottom from February and May down at about 102.5. We got down as low as 102.89, trying to reverse. But this is a company, I don't care about raising guidance, beating estimates. If the stock breaks down technically, I'm not going to be at all interested in it. So I'd watch this 102.50 area very closely. A couple of other areas. First of all, autos, not good. Auto stocks really struggling. They've been down. They were already down about 13% in the last 5 weeks before today, and now they're down another 3 2/3% today. GM, problem here with GM. When you look at their what they reported, they beat on the top line, but they did come up 5 cents short on the bottom line, $1.81 versus $1.86 expected. And then they went on to lower their fiscal year 18 guidance based on higher commodity costs. And as a result, you can see GM getting hit pretty hard. FCAU, this is Fiat Chrysler, a very similar reaction. They missed top line. They missed bottom line. They lowered their guidance. It was the trifecta, and FCAU taking a big hit. So autos and recreational products really holding back the consumer discretionary group today. I did want to just go over a couple of earnings reports very quickly that I thought looked real good. These are going to be companies I'm going to be watching and putting on a watch list. iRobot Corp beat top line, beat bottom line, actually crushed both of them. Stock, as you can see, gapping up above this double top and continuing to move higher. Very heavy volume today. I think that is a really good sign. And then all of these stocks that I give you very quickly are stocks that beat top and bottom line and getting positive reactions. There's Knowles Corp, KN, CNI, a railroad, also breaking out with very strong volume. Then you've got Ingersoll Rand, IR breaking out potentially with solid volume. Corning, I think I mentioned this one top of the show. Look at that candlestick. That is what you call strong action, very heavy volume, opening on the low and currently trading at its high. Very strong candle on GLW. FLIR, which is Fleur Systems, breaking out with heavy volume. HCA, I mentioned at the top of the show, also doing the same. And finally, Grubhub, GRUB, huge report today. Also raising guidance, acquiring a company, and the stock up on very heavy volume. Erin, I know you've got a few upgrades and downgrades. I'm going to turn it over to you.
All right, let's take a look here. I am looking at CROX right now, CROX, and really these came out as an upgrade. I'm going to look at upgrades first. Nice upgrade for CROX. I've got the PMO buy signal. I think this chart looks very healthy. We're getting a breakout from this previous high back in April, and we're holding on to it. An over 6% move, but I still would say there's still some upside potential to get back to that June high without much of a problem. Look at that high scooter. I think this is a good watch list addition. PPG Industries also upgraded today. Big gap up. Managed to puncture through this area of overhead resistance that I've marked here, more of a zone of resistance. And it did manage to pop up above it, but we're now trading back down below the 200-day EMA. I'm still not too worried about this one. It's probably a good idea that it's pulling back a little bit off this big move because we do have a nice positive PMO setup. And like I said, if we can get above that 200-day EMA, excellent. But look at that 20 and 50-day EMA, just about ready to get a positive crossover. And that would give us an intermediate term trend model buy signal. Snap upgraded. You know, what I'm watching here with Snap is the symmetrical triangle. Typically, these are continuation patterns, so I would normally expect to see it, continue this rally that we started back at the end of May. But we're not seeing that just yet. We got a PMO sell signal here. The 50 is well below the 200. Snap's really not looking that healthy right now, and I still wouldn't be thinking too much about it even after this upgrade. Costco downgraded today. It's in I noticed that we have a little bit of a rising wedge, and these are typically a reversal pattern and not a continuation. And that would tell us to expect some downside movement and a breakdown from that wedge. But right now we're holding on to, if you look in the thumbnail there, we had a little bit of support at this top. We saw at about mid-July, and we're holding that little area of support. But I given this particular chart formation, and we did get the downgrade, I don't think I'd be looking at Costco as a bottom feeding opportunity. Diebold Nixdorf, oh my goodness, this one is a very ugly chart, and it gets uglier as you go past in time, but you can see we've broken down with a gap below these May-June lows. But I thought, okay, well, maybe there's some support, lurking there lower. No, there isn't. This is a monthly chart that goes back to 1998, and we're seeing lows right now well below that. So not something you want to see. 5 below is also a downgrade. We've got the PMO moving to the downside, but we're sitting on this support level of that gap support. So I might pay attention to this one. If we can see some momentum shifting here on the PMO, I think that might be a good candidate. Finally, Wayfair, we'll finish up with that. Rising trend channel. It's a downgrade, but we're at the bottom of that trend channel, and actually we're up over 1.5%. I think this one could be an interesting play. Want to wait for it to hit that rising bottoms trend line that forms bottom of that rising trend channel, and watch for that, because that might be a bottom feeding opportunity here. Just beware, the momentum is shifting downward, and you can see we have a negative divergence there with that rising price trend and the declining PMO trends. All right, well, we do have some special guests here today, our Wyckoffian experts. And as we mentioned at the beginning, we just aired their first show last Friday at 3 p.m. Eastern, and it's going to continue on Fridays at 3 p.m. Eastern. Bruce, welcome back, and Roman, welcome to the show.
Thank you.
Thank you so much.
Excellent. Well, Roman, since we haven't had you on the show, maybe you could tell us a little bit about your background and how you know Bruce.
Sure. And I think this is the time for me to switch to my screen. Am I
Yes.
correct? Okay, great. Let me do that.
There you are.
Okay. Well, first of all, thank you, Tom and Erin, for having us and giving Bruce and I an opportunity to promote our charting show. Bruce will be talking about the show a little bit after I'm done. I'm also really grateful to Chip, Grayson, Zach, Danville, Gretchen, and the whole Stock Charts team for setting us up with the show. And I just always love working with Stock Charts team. They're just really, really great professional people. A little bit about myself. I'm going to start with my first trade, my first ever trade. I've conducted my first trade about 22 years ago. It was in the pound dollar. And at that time, I had an e-signal box with the manual data switch. So that just tells you how long ago it was. And I was trying to just do a momentum play without any of the charts. So I was looking at the quotes. And as I saw the quotes, showing some kind of momentum, I was trying to get in on the trade and just follow it. By early morning, because on the West Coast, it's really throughout the night that you trade Forex markets, I was sweating, I was having an anxiety attack, and my first trade resulted in a significant loss, and I had to cover a margin call. Can you imagine on that first trade? And that was probably the most profound and most important trade of my career. Because being a human, I had to emotionally survive that uncertain environment. And therefore, I decided to just study the trading in depth as much as possible. And that led me to Golden Gate University and Hank Pruden. Excuse me. I still remember how I came to Hank's office and how he was showing me the charts, the Wyckoff charts, and I was instantly hooked by his story. I've taken all of the Wyckoff classes a couple of times from him, and all of the technical analysis classes. And this is where I met Bruce. I was a really good student, and Bruce probably can attest to that. I was reading so many books on technical analysis, studied so many methods and strategies, backtested a lot of the stuff. And I've realized that Wyckoff methodology is probably something that I'm really comfortable with, that works for me. And then in 2010, Hank invited me back to Golden Gate University as a guest speaker to one of his classes. And that single presentation has changed a trajectory of my career. And Hank had that type of effect on people. He asked me to teach a 5 through 58 class, which is the class on trade execution and implementation. Then he suggested that I would teach 2 of the online Wyckoff classes, a 5 through 54, a 5 through 55 class. And then throughout the years, I worked closely on different projects with Hank. Together, we've created the online technical market analysis curriculum for Golden Gate University. We went through a great experience with the IFTR 2013 International Conference. He involved me into the TSASF, which is the local Bay Area technical analysis organization. I was the president of that organization for quite some time. I was also an IFTA board member and a member of the educational committee there. At the same time, since 2010, I've been developing my own teaching and consulting business, Wyckofanalytics.com. Wyckofanalytics.com is a very thriving Wyckoff community with fully developed educational curriculum. I've taught technical analysis and Wyckoff trading classes to probably thousands of people now, thousands of traders, and I've done it by myself. I've done it with many teachers, teachers like Bruce, and I'm really grateful, to have that experience, and to continue with my teachings. I always say to my students that if trading is my craft, then teaching is definitely my passion. My trading style is just unique to my mental landscape. I've been searching for my trading identity for quite some time, and I'm really comfortable to say that I'm a speculator. I'm really comfortable trading any instrument in any time frame as long as the trade presents the best opportunity in the current markets. I'm looking for trades that produce the fastest and most profitable results with the relatively low emotional maintenance for me. I'm really happy to be here today for a couple of reasons. The first one is just to promote power charting with Bruce. And then the second reason why I'm so happy today, and maybe you guys appreciate this, after conducting over 200 classes and presentations in 2018-2019 school year, which started last September, this is my last today. I mean, this is the actual last day of this summer semester that I have. I'm literally sitting on my bags, and tomorrow, I'm flying away to my vacation spot. So there are only 2 sessions left today with Bruce, this one, and then WMD Wyckoff market discussion session at wyckofanalytics.com. For anybody who's interested, just feel free to look it up. So I'm a happy camper today.
Well, Roman, welcome to Power Charting.
Oh, yeah, thank you.
It's a huge thrill to be able to not only have our Power Charting show, but to have you as my co-host and to do this together. And I want to attest to the fact I've been doing webinars and teaching in the classroom with Roman for a number of years now. And I want to say that Roman is a true, using a baseball analogy, 5-tool player in Wyckoff methodology. And you can sense from Roman that the emotional aspects, the mental aspects of trading are very important. We have both taught classes at GGU on this subject. I'm sure that you're going to find over time that we're going to weave that in. And so, Roman, it's very exciting to have Roman doing this program with me, and we're going to have a lot of fun every week with this. And the emphasis of the program is going to be to identify stocks using the scooters as a methodology, a screening methodology, and then identify these different stocks and different aspects of their where they are in their scooter relationships, and then evaluate them with the Wyckoffian eye. And so that is going to be our mission, and we intend to use this as a framework to teach Wyckoff. And so it's going to be hands-on. It's going to be case study methodology, which is what we learned from Hank, was to teach with a case study method. And you're going to see that we're just going to keep, going over these different charts and going over the principles over and over again. And through that, we're all going to get better and better at Wyckoff. So, Roman, why don't we take a look at some charts?
Sure.
So what are we looking at here?
So our first chart is just the market, S&P 500, and we thought that maybe this is a good, start for us on this show, just to talk about the market in general, the market in comparison, to other markets, and then to give you an example, maybe of one stock of how we look at things. So, Bruce, what I'm looking at here is a very predominant trend that we had in 2017 going into January of 2018 into more of the climactic run. We see a lot of velocity increase, momentum increase on the last swing to the upside. The spread is increasing, and that results in the buying climax, stop in action. After that, we're seeing a lot of change of character. Change of character is a very unique, a very interesting concept. It basically tells us that we are shifting from one environment into another, from in the environment of the uptrend into the environment of a trading range, of a consolidation. And it's during the consolidation that we have to decipher what kind of buyers we could possibly have for the price coming out of this this consolidation. The move to the downside, which was very aggressive on a lot of increase of the volume signature, a lot of supplies coming in, has a stopping action of its own. It's a selling climax. It also has a localized test, which still has a lot of supply behind this. Usually this type of action suggests that there's going to be some kind of retest further down the road. At the same time, a really good rally, not necessarily retesting the buying climax high, but showing that there is an ability to rally, suggests that the next test is probably going to be successful. So at the secondary test, we have multiple points where the price has tested the support area, and we've seen that by the last point of support, where we are registering a high low, we're also observing the volatility contraction and decrease of the volume signature, in general decrease of the supply signature. That suggests some kind of rally. And these are usually the places for us where we're going to start thinking about opening the positions, where we're going to start thinking about the selection, where we're going to go through the selection algorithm of what we're going to trade for the next move to the upside. A couple of higher highs, which we would say they are forming a minor sign of strength. The price still within the larger formation here, but all of the reactions to the downside are actually quite manageable, and they are within the context of the uptrend that we have. A minor backing up action suggesting a continuation to the upside. And Bruce, let's discuss this last action right here at the on the right of the chart. What are you thinking about the price and the volume signature here?
Well, the thing that's we're most concerned with is that we see a lot of resistance that is has formed very early in this change of character. This one of two things is going on here. This is either a reaccumulation or it's distribution, and so we can see from the analysis putting in overhead resistance lines that we have an area of resistance in the S&P, and we're just above it. And this actually is a very important place because this is a danger zone, because resistance we drew this at the upthrust action, that this resistance level is a place where large interest, large informed money managers will step in and supply the market with stock, meaning that they're selling. And so what we want to test for here, now that we're all the way from the support line, we've rallied all the way up to resistance, whether or not we have a failure back into the trading range. And so that is something that we're really looking for. We're watching these bars day by day to identify them. The good thing that happened in the last few days is that we had a backup, and this backup occurred on a lot of volume. And so those two little red bars in their very tight range days with a high volume, which we would interpret that as being potentially a good sign, because it's a sign that this supply that showed up here is being absorbed. And we had a pivot and we've turned back up. So now what we want to see is we want to see follow through. So you can see all this trading in here, this congested trading where there's been a lot of choppiness, has been an attempt to absorb the supply that is overhanging the market up at this resistance area. And then the next stop is the high of the buying climax. And that area is going to represent some resistance also. And so these are the things that we would be studying. This is not the place that we would initiate trades on the long side. This is not a place where we would buy. We would tend to buy on the backups and the last point of support and the secondary test. Those are the places when we get turns off of those areas where we're looking for good entry points. And so the other thing, so anyway, I'll leave it at that for this moment, but Roman?
Yeah, I really like this area right here because it's a little bit trickier, and usually, whatever is tricky actually, attracts my attention. I think that we've been calling the market actually really nicely, especially since this area right here, it showed a lot of absorption in the way how price was moving up, in the market, suggested that there are quite a lot of trading opportunities right there. You just had to be a little bit more selective than the area, of the rise in 2017. Now, this specific area suggested that maybe there is some kind of deterioration of the demand. So demand was becoming of poor quality. And it's probably more associated with the selection process, for the institutions. They are more selective now than they were in 2017. So one of the thoughts that I had here around the area of the resistance is that we're probably going to come back, at least to the area of the support. And we did not. So what does this tell us? That tells us that whatever supply is trying to come in is, this supply is being observed. And the point that Bruce made here on the increased effort to the downside, we are not having result increase in the direction of that effort. So there is no synchronicity, there is divergence between the effort and the result. And that suggests absorption and possible continuation. Now, this yesterday bar was very interesting because it upthrusts, it tries to commit to the upside, it actually does so. And it has some effort behind it. So we know that some supply is coming in on that particular bar. Yet, today, we are actually absorbing that supply. And I think that today's action is actually quite positive. So I wouldn't be surprised if we would try to continue to the upside and actually try to retouch the buying climax high. Bruce?
Absolutely. And so we're always testing the market. These are very Wyckoffian concepts, and we go over them and over them and over them. And it's real-time analysis where we're looking at it bar by bar. And this is what we intend to do in power charting. And here we're looking at the S&P 500, but we'll do a lot of work in individual stocks. And we'll use the scooter rankings to identify candidates to analyze. And this is going to just be a lot of fun. So, Roman, we have a little bit of time left. Do we have some other charts?
How much time do we have left? I thought.
I think we have like maybe 10 more minutes.
10 more minutes. Okay, so we have 2 more slides. Yeah.
And we want to maybe take some questions too. So.
Oh, okay. By the way, I really liked your definition there of the danger zone. That was great. Thank you, Bruce. All right.
Well, that's why we do this together.
Yeah, so, I like that. Okay.
We've done a lot of teaching in the classroom together. So we're like a couple of old shoes. We're just like
but that was something together. I haven't heard this from you before.
Oh, okay.
All right. So, Bruce, we're looking at all of the 4 indices here: S&P, Dow, Nasdaq, Russell 2000, which is the IWM, the Russell 2000 ETF. What do you see here in terms of the performance of different indices? What is outperforming? What is your view on comparative analysis?
Well, the two lagging indexes really are the S&P 500 and the Dow. And I think that the Dow is particularly interesting because it is way behind how the other indexes are performing. And I believe that the Dow might be sort of the key arbiter of what's going to happen in the market as a whole. And that sounds kind of strange because it is the laggard. But here it is right now up against important resistance. And Roman, just show them the climax, the selling climax in the automatic rally. This is such an important concept. And this is just worth the whole day is when you can get identify the selling climax in automatic rally. Now you have the low point to draw a support line and the high point to draw a resistance line. Now, look at how well the Dow Jones confines itself within the boundaries of support and resistance. And this is such a valuable concept. And here it is back in early February saying this is where this market's going to trade for the next 6 months or more. Who knows how long it's going to be up here. But here we are, we're at resistance. And I believe that this is a very important place. Couple of things that have happened. One is that when it declined down towards support back in June, you can see that it was unable to get all the way to the support line. Well, that is in its of itself is a measure of success or strength in that it was able to do that. Then it formed a little like mini accumulation there where it paused and then turned back up. Now it's pushing up against resistance with a reasonably good rally. Well, so this last decline might very well be a last point of support. And this is a term that we use. It's a concept where we would actually enter trades into a last point of support or on the turn off of that. Well, now that we're up to resistance, what we really need to see from the Dow is the capacity to jump here. And you can see that it tried to back up. It stayed very close to the resistance area and has held firm, and now it's knocking on the door. So what we want to see is we want to see a good jump up and then an ability to be able to stay in the range of this resistance line and potentially stay above it. And the best of all conditions would be that it just runs away from it and goes right up to the prior highs at the buying climax. So I think that the Dow is sort of the litmus test here. Roman?
Hey, Bruce. Roman?
Yeah, sure.
This is very fascinating, and thanks for going over all these different indices. I think this is really very educational, and the marks that you made on the Dow and the fact that it stayed contained for so long, that has been pretty fascinating to watch. Does it change your opinion at all when you're looking at the Dow, when you see the NASDAQ break to an all-time high, the Russell 2000 break to an all-time high, and the S&P break above that reaction high in March? Does that give you more of a feeling that the Dow is going to make the breakout, or does that not matter to you all at all?
Well, in my mind, well, first of all, the instruments that we're trading are going to be in the leadership. So we're focused on the NASDAQ, we're focused on the Russell, and also the leadership stocks in the S&P. So throughout this whole period, we're identifying where the leadership is, and and just staying with those. And you can see, especially in the Russell, that it's just had such a good uptrend. And I have sort of a comment on the Russell here in a second. But I'm just thinking of the Dow as more of a litmus test. And I actually believe that this is very encouraging for the market as a whole, that these other indexes are stronger. My cautionary note would be, look where they are in their trend channels. And so they are pushing up against the top of their trend channels, which means that in a Wyckoffian definition, they're overbought. So that doesn't mean that they have to go all the way back down to oversold, but it does mean that they may need to pause here. And so it's interesting that everything is kind of pushed up against overbought here in the Dow, which is the laggard. So my feeling is that if the Dow can jump up and out, that it might actually give cover for the NASDAQ and the Russell to rest, and the action might come in the Dow stocks or the Dow type stocks. And so the Dow might become leadership in a sense for some period of time. And that doesn't mean the NASDAQ and the Russell have to be in any trouble. They just may consolidate. So that's sort of the way I'm looking at it.
I would agree with this, and kind of like Tom led with this question, I was actually going right into that point. There is a little bit of the rotational story that we see in the most recent, 2-3 weeks action. We kind of could see that the Dow right here is starting to outperform the Russell and NASDAQ. And I think it's probably related, to everything what's going on with the trade talks and with the tariffs, because this whole change of character that we've experienced in after January and February is most likely related to the uncertainty that institutions experience with everything that's going on with the trade talks and tariffs. And obviously, the big multinational companies are going to be experiencing, some doubts as to what's going to happen, to their revenue stream. Whereas the smaller companies or the technology companies are, less prone to this type of reaction. So lately, we're seeing a change, a rotation, between the leadership. So that gives us a very interesting technical clue on the fundamental data that is coming in, from or macro data that's coming in, from Trump administration and the whole trade talk. So very good point, Tom, and you're just catching up this rotation pattern right here.
Yeah, and I would also add, if I could, the dollar index, which had been on the rise since earlier this year, has kind of hit a key resistance around 95, and the rising dollar also rotating into the smaller companies, as a lot of the S&P and stocks, of course, are multinationals, and so their foreign profits are being brought back in with a more expensive dollar, and so they're getting some negative currency translations there, which I think has been impacting the market as well, and that kind of goes along with the whole talk about the trade and tariffs and so forth. But my feeling is that after this is over, I expect the dollar is going to go higher and that the Russell 2000 will break out. And it's, I guess from your perspective, you want to see it first. Is that correct?
With the Russell specifically, I think that we're going to be confined within this range right here. The way how the last 2-3 weeks are unfolding, with multiple attests to retest the resistance to break out, all of them have failed. And specifically yesterday, some supply is coming in. So I would be saying that the leadership that the Russell has had for quite some time is going to be short-term, temporarily not there, and it's going to go into the consolidation. And that's why I think Bruce is saying that there is a much better chance, let's say, for the S&P and the Dow, to overcome this resistance. And I think technology is just a very specific case here. We have to be selective a little bit with the technology, but it's probably a safer bet, with everything else that we look at in the markets.
Yeah, point very well taken. Erin, I know there was a question in the room.
Yes.
So that gets asked. And
yes, there was one for sure that.
And we have one more slide after this, by the way, guys.
Okay, go ahead, Erin.
Okay, no problem. Okay, so the question is, does time factor into Wyckoff analysis? Is there certain time frames? Can it be short term? Is there long term, or is it sort of like a point and figure?
Bruce, do you want to take that?
Wyckoff is, as a matter of fact, at the last Market Watchers Live that I was on, I actually focused my discussion on intraday analysis with Wyckoff and demonstrated that the principles are at work in the shorter time frames and in the longer time frames. And the point and figure works. I've written a number of blogs using intraday data for point and figure and very long-term data for point and figures. And so the vertical charts and the point and figure charts really work well in multiple time frames. And so it's a great tool no matter what. As a matter of fact, I think you can go back in the on the Stock Charts TV channel, YouTube channel, and I think you can find that discussion from last month. And so it's sort of a nice introduction.
Excellent. Did you have a question, Tom? Because I know somebody was asking about a stock in particular, but I wanted to make sure all the general questions get in.
Well, let's I know Ramon said he had one more slide, so let's go ahead and take care of this one first.
Perfect.
All right, Bruce. So we're looking at the Honeywell here. Why don't you start with your analysis here?
Well, Honeywell, we don't have a lot of time, so I'll just make some brief points. This is a reaccumulation structure. So there's accumulation structures which occur after long downtrends. The S&P, the indexes we just looked at, are what we're hoping are reaccumulation structures, where they, after a long uptrend, they pause and rebuild point figure count and rebuild for another run, another move up. So Honeywell, looking at this, we're looking at this as a reaccumulation structure, and you can see that after a long uptrend, it had a change of character, climax, and then sell off. We're calling that a selling climax, and now we're in a reaccumulation. The whole point of Wyckoff is to identify that, in fact, the large interests are reaccumulating or absorbing the shares of the stock. The stock cannot go up unless it's in strong hands. It's that simple. So we're identifying the evidence or the footprints of strong hands accumulating shares, and we want to see that nearly complete before we step in and then take the ride with these large interests. We want to go with them. And so here you can see in conclusion, you can see this phase C. And the way that Wyckoff looks at charts is that they have to go through a process. They have to go through stopping the decline. And then they have to go through a period where stock goes from weak to strong hands. And then you have the final testing. And now that the stock is in strong hands and it's very hard to buy in quantity by institutions, it starts to move up easily and effortlessly. And so our intention is to get on board when that is ready to happen or is happening. And this is what we call phase C. And we develop our Wyckoffian eye to identify these phase C scenarios, phase D, which is the beginning of the markup out of the trading range. And so this is what we're looking at here, Roman.
Well, one of the things that I want to give you guys in this presentation is that think of the phases as segments in the trading range, and think of the segments as the areas where the testing of the supply always happens. So we have the first area, the first segment, where supply is very dominant and it's very aggressive. You could see this from the price signature, the spread increase, the violent moves to the downside. And then look at how volatility starts to decrease as we go into the second segment in phase B. And then phase C, third segment, third test, has the lowest volatility. The spread is small, and then we have kind of this grinding up action, which is an absorption on the way up of the supply that is still remaining right there. By the way, we're going to talk about the scooters a lot, in our power charging program. Look at how the scooters breakout and the price breakout out of the short-term trading range confirm each other. And actually, one of the positive things is that, the long-term or, maybe intermediate-term high is also confirming both on the scooters and the price. Bruce?
Perfect. I think we should leave it there. It's, I know we're nearly out of time.
Usually we are so, behind the time. We usually spend more time, but now we're on time. That's great.
The faster we go, the behinder we get.
Awesome.
Yeah. So
I know you're going to head out here in 1 second, but I do have one chart I want to go ahead and share with you, if you don't mind, and just get your quick and dirty 30-second opinion on.
Love to.
This is the XLF on the financials. And so here's the chart where we had the move up back in January. Here is that selling climax. We had the reaction high back up around 29.5. You're going to love this, Bruce. I mean, I'm actually getting into this Wyckoff stuff here. As we made the breakout back above 26.5, you can see that actually is pretty good price support coming in here as well. And my question is, and I know you've talked about this before, when you have these reaccumulation zones, sometimes you'll get a spring where you get this false breakdown and then start to turn back up again. So my quick question here is, if you were looking at the XLF, do you believe that that's a spring? Would you be a buyer of the XLF here?
I would treat that as a spring. And it's a great example, and you have a really nice change of character. Look at how after the spring, it fails to go down. So the key with a spring is when it springs the low, does it keep going? And so it doesn't. It can't get ahead of steam. Look at all the volume down there. Well, that volume is actually, there's a lot of demand in that volume, and it's keeping the price from breaking down. And so this actually encourages the large institutional interests to keep buying. And look at the nice change of pace as it turns off of that and just starts to go up. And it's just, marching up. And the rally is better than the rallies that preceded it in the trading range. So this is really encouraging for the banks, for the financials as a whole. As a matter of fact, in my last blog, which I just published on Monday, my blog was about JP Morgan and about the larger discussion about the financials and have they put in a spring and are they ready to lead again?
Yeah, here's that JPM chart that you were talking about, taking out those prior lows, coming down here, heavy volume, and then look at that rebound. This actually, JP Morgan's not far from a breakout, which is really encouraging given how the selling that we saw earlier this
and I think that's encouraging for the whole market, is to have these financials acting so well.
No doubt about it.
Yeah.
Well, Bruce, Roman, it was really great to hear from you. I know everybody was fascinated. We were fascinated watching you go through this. Just want to remind everybody, Fridays, 3 p.m. Eastern Standard Time, power charting is now going to be on. And if you liked what you saw here, you definitely are going to want to tune into that. Appreciate it, guys.
Thank you. Thank you both. Take care.
Awesome.
Yeah.
Awesome. I really enjoy, because I do find it fascinating that it's more of a psychological thing, or, trying to understand what's going on in the market when we get these pullbacks and you move forward and then you pull back. It really makes sense when you get that Wyckoff explanation, I think.
Oh, absolutely. Volume is important,
Yep.
Okay, well, we have a lot of 10 and 10 stocks that have been requested. I'm not going to show the RRG because we are running just a little behind time. So let's go ahead and get started with the first one, APA. And a reminder in the chat room, if you're watching live, go ahead and like other people's symbol requests because the most popular will be our very next symbol.
Okay, well, first on Apache, and I'll go through these pretty quickly, but you can see it's pretty clear double top. We rallied in January, had a huge period of selling throughout February, and then we've rallied all the way back up to test that high, maybe got just a little bit below it, above it, put in that doji, and then we pulled back. Now, I was looking at this as really a double top breakout and then a reaction low back to gap support around 43. So I'm looking at Apache right now in a trading range between about 43 to the downside, 48.5 to the upside. We've also got trend line support coming in around 42. So I'd have a fairly tight stop down to the bottom, 42, 43 range. But currently APA is in the middle of this trading range. So at this moment in time, I'm not a big fan. The other thing is relative to its peers, it has actually been downtrending. It is not doing as well as many of the stocks in this industry group. So I think there's reason for pause here. I'd either need to see a heavy volume breakout or maybe get closer to that support level.
Okay. Let's see. Our most popular in the chat room is Alibaba.
Great. Alibaba. Another one that's been doing a lot of sideways consolidating, mostly in a trading range between the tops here, 205 and 165. That's a pretty wide range, but you go back a year, and that is where we've been mostly confined, and we're sitting at 195 right now. Had a big volume decline back in the third, fourth week of June. We've rallied back up, but I think we got to get through that gap resistance area. That was heavy volume selling. So I think you might see some sellers show up around 198 on this advance. Ultimately, we want to get above 210, but I just see a lot of consolidation, and you've got a lot of others that are performing much better, have much stronger momentum to the upside. So I'm going to pass on Alibaba.
Okay, next one we're going to do is Pieris Pharmaceuticals, a biotech, PIRS.
Okay, well, I can tell you that biotechs have been much stronger than what this stock has been. So from a negative perspective, I would be careful because it hasn't been performing very well. If there is a positive, I would say probably it's the fact that we've got this channel that the stock has been in for quite some time. Won't be an exact channel, but pretty darn close. I mean, if we connect those lows, whoops, that's not what I wanted to do. Let's try this again. There we go. So it has actually been in a pretty decent channel. Now, this move up, you can see we're getting a golden cross, the 20 going above the 50. PPO is now positive. So it's starting to show some good signs. And after this move up on increasing volume, it is pulling back. I'd like to see that rising 20-day moving average hold. I don't want to see it move back down into this channel after breaking out. So I think short term, we've got some positives here developing. I do like the group overall, but since February, it has been an underperformer. So the breakout is nice, but let's make sure it sticks.
All right. Next is a software company for you, Blackline, BL.
All right, BL. Mostly higher here. I like the trending uptrend. I like the space that it's in. So after going sideways for quite some time, I think it's pretty clear now that we've got a trend line in play. And in addition to that trend line, you can see that the recent selling and low was at about 44. Trend line's about 45. So that's the area of support I'd be watching. 50 is your area of price resistance. Again, we're in the middle. I prefer entering when my reward to risk is in a much better position than it is currently. The only way really you can set it up now is to assume that you're going to get the breakout. And I don't like to make that assumption. So for me, it's not a trade at this point. I think we're in just light volume consolidation mode. Get down closer to 44, 45. I begin to like this one a lot better.
All right. Driving forward, how about Avis Budget, CAR, CAR?
That's another favorite ticker symbol of mine. Kind of spells out what they do.
Exactly.
A little bit of a head and shoulder breakdown here, and the volume accelerated on it. So I'm not going to be overly thrilled with this, but there you can see the neckline coming across. So you got high. Here was a move up. You go down, put in your left side of the neckline. This is your left shoulder. You break to a new high, puts in the head, come back down right side of the neckline, a right shoulder, and then absolutely an explosion to the downside with heavy volume. This is a classic topping head and shoulder pattern. I think maybe we got a little bit of a positive divergence, which means we could perhaps make a short-term run for the 50-day moving average. That coincides with neckline resistance. So it's got an opportunity here in the near term to possibly make a run for 37.5, 38. But if it gets there, I'd be a seller and make sure you can get through that neckline resistance.
Excellent. And I recall you talked about this one yesterday. I think you were saying it was on your watch list, PayPal.
Yeah, PayPal is definitely one that I'm keeping an eye on. PayPal did break out recently. I think it's in a really good space. It had sideways consolidated here for several months as the market was consolidating as well. But you can see off of the November high, we pulled back in December to about 70, and we've gone back down. We've tested that. The high above that, you can maybe put in a couple of levels right in here. The high back in January, then again in June. Pulled back off of a negative divergence, higher price, lower PPO. That sent us down to the 50-day moving average. We have since broken out. Volume is strong on this breakout. I like PayPal. I just want to see it on a pullback. Maybe if we can get it back to the 20-day moving average, it would look much better.
Okay. After that, we have BITA, BITA, BITA Auto Holdings, media agency.
Yeah, I think this was one that maybe I had talked about as a possible sleeper, maybe, because I know I was looking at the media agencies. I can tell you the media agencies since that discussion have kind of fallen apart. But the stock is starting to show some strength here. And I think a breakout above 25, if we can confirm it, would be a short-term positive. There's your gap down on very heavy volume at 25. We've really struggled to get back through 25, and we're trying to do it today. One problem is light volume. So if you leave a tail up above 25 and you go back down and close beneath it, I think the short term, you still have to respect this overall downtrend. So that would be the caution would be a failed breakout here with an overall downtrending stock could be a warning sign. But a breakout, if we can get that breakout, I would begin to look maybe for a retest of that high that we saw back in the second week of June, up closer to 28.5.
Okay. 3 more to go. Let's move on to Expedia, EXPD.
All right, Expedia. Well, huge gap down back in February. Took a while to get back and fill that gap, but we did finally fill it and even move through it. So there was your gap resistance. That's where we gapped down on very heavy volume back in February. We moved up, we broke above it, pulled back a little bit, and now we're trying to move up again. There's another key area of resistance. So after the huge gap down back in October, the reaction high, we had a triple top at about 132. So I think in the short term, we've still got room to the upside. If we could get through 132 and get some volume coming in, I think it could be another quick 10% up to test gap resistance around that 146 level. So I'm a little skeptical at this point. I'd like to see a volume breakout, high volume breakout. I'd be looking for that to occur at that 132 level.
All right. Let's go ahead and move on to our only consumer staple that was requested. How about USNA?
All right, USANA Health Sciences. Wow, I don't know if they came out with earnings, but it looks like an earnings kind of a candle and volume. I love the breakout. I really like it when you've got overhead resistance and you gap up and open above the resistance. I think that's a pretty good sign. And the fact that we now have a what I refer to as a Maribozu candle, which is a open on the low of the day. And right now we're near the high of the day. So you have this big hollow candle. That just tells me there's a lot of demand for the stock. One negative, really the only negative on this stock, is when there isn't news out there. You can see it doesn't really trade a lot. Back earlier in the year, it was routinely trading at 100,000 shares or less a day. That's a little bit of a downer for me. I prefer to have a stock that's a little bit more liquid, but I can't argue with the chart here. I think this is a nice looking chart.
Okay. And let's finish off with steel. X.
All right, last one, X. Well, off the selling, we keep rebounding and trying to get through key resistance level here at about 38. You can see yesterday we gapped above it, left the tail up there. You can see the tail we left back at the end of May. Many times that will result in some short-term weakness. So if you're trading USX, you really want to see a confirmed breakout above 38, 38 and a quarter. And by confirmed, I'd like to see some more volume coming in on this breakout. So until we get that, I think we're sitting right at resistance right now. I would not be a buyer at this level. But if we get some volume, we can get that breakout. I think all of a sudden this turns into a much better looking chart.
All right. And that completes our 10 and 10 to 1. And there are all the symbols that we looked at. I will get these up into the Market Watchers live chart list as soon as the show is over. All right. We'll be back after this message with the final market update.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
All right, time for our final market update. As you can see, we continue to see a little bit of bifurcation in the market. Right now, the Dow Jones is lower, just over 37 points. S&P 500, though, is rising. NASDAQ looking pretty healthy, as is the NASDAQ 100. But mid-caps are also in the negative with the Dow. And, you know, Russell 2000, we are finally seeing a little bit of action here to the positive side for Russell 2000. And small caps, to the TSX similarly is moving higher into positive territory. Treasury yields are down just a smidge, 2.93% currently. UUP down. And we could see that gold, of course, is managing to get something out of that with a big gap up. And it did pull back about half of those gains, but still rising. And we can see we are at 116.48 for GLD. Oil up on the day. Actually looks like it's forming a intraday flag at this point, up almost 1.5%, USO 1444. And finally, the VIX is moving lower and getting very close to that 12 level, currently at 1215. Did want to quickly show you our headline news from the predefined alerts. And we could see that the New York Stock Exchange Summation Index crosses below its 20-day SMA, and that's the McClellan oscillator. And I wanted to just show you that chart very quickly. But here is your NYSE, the price action. But right down here is the McClellan Summation Index. And as you can see, it has now moved back down below its 20-day simple moving average. And that concludes the final market update. Tom, would you like to add a chart?
Sure. You know, you mentioned the Dow, you know, in fact, we've got a bifurcated market and the Dow's down. I looked there, about half the components are up, half the components are down, but the one that's really dragging the Dow down is Boeing. Boeing came out with their earnings. They did beat on the bottom line, and I was looking, they've raised their guidance going forward, but even after raising their guidance, it was still below consensus estimates, which I don't quite understand, but it was. And so the market was a little bit disappointed. You can see this is a long-term monthly chart on Boeing. We have had such a huge run up in Boeing. It wouldn't be a surprise to see sideways consolidation. We had a big run up back in 2013, and you can see that resulted in sideways consolidation for a year. in 2014 on Boeing. I'm not going to suggest that that's what we're going to see, but I do think we have to keep things in perspective here. And after a huge run up where Boeing more than tripled in about 14 or 15 months, sideways consolidation for a bit longer certainly wouldn't be the most horrible thing. The monthly RSI, as you can see, has been over 70 for a year and a half. We've never really, maybe I guess 2005, 6, and 7 was a little bit like that, but this is pretty overbought on a long-term chart. So I wouldn't be too discouraged by Boeing struggling in the near term. Just keep in mind that it has made such a huge run up heading into 2018.
All right, excellent. Okay, I'm ready for my scooter report. Are you ready for yours?
Sure, go ahead, take it away.
All right, let's do this. I wanted to follow the same theme as I did yesterday in the technical scanning a little bit here in the scooter report by following up and using a predefined scan and manipulating that in a very simple way, really. It's not that hard, so I'm going to show you, to look for scooters in a range that will probably help you find some really good candidates. So let's real time find some good candidates here. I like using that new 52-week high scan. So I'm going to go over here. There's actually 183 stocks currently coming up in this particular list. You can see we have London in here. We have, Canadian stocks. And, I'm going to go ahead. I need to pare this down from 180 plus. So I go to my technical scanning workbench. And as you can see right up here in the right corner is where you can get to it. And that sets you up with just the beginnings of a good scan. So I decided to add, and I've already completed mine, but I decided to add a country being US, since that's where I'm looking to invest in equities. And then I wanted to get a scooter between 60 and 80. And for those of you who don't know what a scooter is, it's the stock charts technical rank. And if you go to chart school, you can get the actual calculation for it. But we find that it's a really great measurement of not only relative strength, but even internal strength by just seeing how strong a scooter value is, not necessarily in relation to other stocks. So I wanted one between 60 and 80. I wanted something a little bit stronger, but not already riding high. So I decided to add looking for scooters between 60 and 80. So I'm going to go ahead and just, like I said, this is real time. I'm going to run the scan. We got 34 results. That's manageable for me. That was from 183. We're down to 34 just by adding those few segments into the scanning workbench. So now I'm going to replace a chart list. This is my scan dump. This is where I dump all of my scans into. It's a transient particular chart list, so I pull from it. So I just throw everything in there and then I can start moving along. But I know I'm not saving that list, so I don't get too attached to it. So I have my candle glance set up. And you can set up your own candle glance by just, setting up that chart style the way you'd want to see it in a candle glance, and then save it as candle glance. And then it'll come up every time. And so this is what I like to look at, my PMO, and I like to see my moving averages on there. I decided to add a thicker OHLC bar as well. But what we can find here now are those that are, I'm getting some interesting PMOs, and those where maybe I see a nice breakout. Right now I'm looking at Coca-Cola European, actually, CCE. And I'm noticing this one because you could make a case here for a flag, right? And let me go ahead and annotate that. Flags are bullish formations. They're typically one of the best performing as far as execution is concerned. And I'm going to pull that up back a little bit there, but that's the flagpole. And you can see we have a little bit of a flag going on here, maybe even a little pennant. And so we've gotten the breakout from that declining tops trend line from that flag, and that could technically execute it. We don't have a close above it just yet, but I find this very interesting. Problem, of course, is I have an overbought PMO that is turning down. So I would want to exercise some caution here. And personally, just for the way I pick my stocks, I don't pick overbought turning down PMOs. But I wanted to give you the point that that's what one of the things you can do is to look for specific chart patterns in your candle glance. So let's look at a few others that might be interesting. Now this looks very interesting. We have a big breakout here and a PMO that is now turning up, and it's above the zero line. It's setting up a bottom that is higher than the previous bottom. So I have a nice positive configuration here, a positive confirmation, bullish confirmation. I'm looking right now at this double top, and it never executed. In fact, we got a rebound. And so that tells me there is some strength there. It rebounded right off that 50-day EMA, which I like to see, of course. And now I'd be looking for that breakout. Of course, I would leave this into a watch list just because when you have those big moves to the upside, as Tom says, we don't like to chase a stock. So getting a little bit of a reaction pullback, which you generally are going to see more often than not, I would want to wait for that. But I think that this has some pretty nice upside potential if you get a little bit of a pullback. Looking for that high back in July seems certainly possible. All right, a few more here. Let's see what is poking out as far as my PMO is concerned. This could be interesting. Let's see. Yes, I think this is very interesting. Let's go ahead and annotate this. This is FBNC, First Bank Corp. And the first thing I'm noting, I'm going to pull up a horizontal support and resistance. There we go. And you can see we had the breakout today. We're already experiencing a 2.5% upside move, but I would be more comfortable with this one in that I have a really favorable PMO that has been rising for quite some time on that rally. And now seeing that breakout, to me, that confirms the positive picture here for FBNC. So I think that's very interesting. And there you go. There's a scooter. Like I said, we're looking at those scooters between 60 and 80. So we want something somewhat strong, but not necessarily at the top. I want to find those momentum building stocks with a scooter that has room to grow and, hopefully find a good chart pattern and a breakout, which is what we see here on FBNC. All right, a few more here. It's like I have just a bit more. Let's see, one more. Let's look at, I need a nice PMO here. That's an awfully big move to the upside. This looks interesting. Spirit Realty Capital. Now we're getting ready to test that overhead resistance, but we bounced nicely twice off that 20-day EMA. And so this works very well. I would be looking for a breakout above overhead resistance. All right, so I think I'm going to pass it back to you, Tom, because I know that we have, you have some very interesting scooter stocks, I'm sure, to show us.
Yes, I'm going to take a little different approach. I'm going to go with some 52-week lows and show you some scooters on those particular stocks. But what I did, I don't want to spend too much time going over the scan, but I can kind of tell you what I did. I went into the predefined scans, and I started with the under bearish technical indicators, these 164 stocks, new 52-week lows. And then I went in and I just said, well, give me the ones that have more than 200,000 in terms of daily volume, because I don't want illiquid stocks. And give me the stocks that are in the S&P 500, the S&P 600, and the mid-cap 400. So those were the 1,500 stocks that I looked at. And what I ended up coming back with was, and I'm going to pull this back up because I think I didn't want to start with this one just yet. Well, let's go ahead and take a look at the results. So after doing all of that, there were 18 stocks that came up on my list, and I've sorted them in scooter order. So it goes from 12 down to 0. And you should expect this. If a stock is trading at a 52-week low while the market's either breaking out or on the verge of breaking out, then it makes sense that these 52-week low stocks are going to have very low scooter ranks because they're being compared to their peers. But just taking a look at these, my question was, okay, are there any of these stocks maybe that potentially we could consider bottom feeding? And one way to do this is just to pull up the 10 per page, where I can look at them fairly quickly, but I get my big screen, I get the big chart. And the first one that pops up, AEIS, to me looks like 57 was pretty good support. We got all the way down to 56 and we're seeing a reversal. So this is one that potentially could be putting in a bottom, maybe in a longer term accumulation phase. Let's take a look at the longer term weekly chart and see if that's the possible case. Well, so far, this looks a little bit like the home builders that I showed earlier today, where it's gone below the 50-week moving, 20-week EMA, and it's not been able to get back above. So until we can get that, that would probably bother me. But AEIS is certainly one that from a short-term price support perspective could be putting in a bottom. So that is worth at least considering. If we go back and take a look at the next one, Benchmark Electronics, well, that's not going to interest me at all. We've got a huge red candle breaking down. We're near the lows of the day and volume's massive. That would not interest me at this point. Dana Inc., DAN, I think this is an auto parts company, opened at around 20, which was above support, but it is currently trading down. So unless we had a big reversal, that one wouldn't interest me. We've got a triple or quadruple bottom breakdown here on DBD, gapping down to open below this resistance, or excuse me, the support level. I'd have to see a major reversal there. And that's going through this exercise. That's really what I'm looking for. Maybe some reversing candles. eBay is possible. eBay, I believe, was the only one on the list when we pulled it up that actually was positive today. So it was setting a 52-week low, but it's reversed off of that 52-week low and is actually up for the day. So eBay trying to put in a piercing candle, which off of a downtrend is a short-term reversing candle. So eBay is one I might consider looking at a little bit further. Goodyear Tire and Rubber, is that an exhaustive gap down with a hollow candle? Possibly. Today on an intraday basis, we went just below and starting to turn back up. So here's another one that possibly could be trying to reverse. JetBlue, not interested. Huge volume breakdown yesterday, continuing that move to the downside. I don't see anything yet to get excited about there. Lithium Motors, hammer. So maybe on the short-term basis, we'll see a little bit of recovery, but we gap down on massive volume way below this triple bottom. Not looking good here on this one. I think eventually we go lower. NYCB, which is New York Community Bank Corp, making a breakdown, but so far a little bit off the low. Let's see if we can get back up and hold that 1090 support area. Papa John's Pizza. I don't think I'd want any of their pizza today. I don't want a slice of this one, that's for sure. And let's keep moving on. We got a few more. Sanderson Farms. Another one that's right at support. I'm going to pull up this one a little bit on a longer term chart and see what this one looks like, say, going back weekly for the last few years. Well, another one that continues to trend below the 20-week moving average. So maybe we're putting in a double bottom, but that wouldn't be confirmed until we break out above 110. So this one, again, I'm not going to be a huge fan here. Just a few more here. Signature Bank, clearly broken down, heavy volume, doing much worse than the overall banking group. So I'm not interested there. AT&T, I wondered about. They did report earnings. They beat, and the stock still gapped down and continued to trade lower. I was wondering if maybe we would get a reversing candle right at support. So far, that's not the case, but it could be by the end of the day. One to keep in mind. Thor Industries breaking down below support at 90, 92. Not looking very good there. Toll Brothers, we talked about the home builders earlier, breaking down, looking like they've got more room to the downside. And Toll Brothers breaking down certainly looks like it's got more downside as well. Tupperware Brands, TUP, breaking down on heavy volume. That's probably earnings related. I'm not sure. And then finally, actually two more. Ultra Clean, UCTT. We had a triple bottom, 15.5, but it looks like we are breaking below that. And then finally, Whirlpool. Talked about this one yesterday. Just a continuation gap down here on very heavy volume. It's continuing to move lower. I'm not a fan of Whirlpool. So anyway, I just wanted to take a little different approach. We can bring up the summary. But that was just a little different approach to the scooter. Taking a look at, I'm always pulling up scooters that are pretty high because I trend, look at stocks that are trending higher. But when you look at the ones with low scooters, the technicals just don't look very good. So unless you're bottom feeding from a value perspective, it's really hard to get behind these stocks unless they put in some sort of reversing candle, maybe at support. And by the looks of many of those, they weren't looking very good. So anyhow, that's how Erin and I got to our scooter report stocks for today. Hope you enjoyed it. I know, Erin, we did, before we get into an individual stock or two, because we got a few stocks coming up with earnings after the bell today. I think a few folks might recognize these names, but before we get into that, let's pull up the poll for today, because we were talking about ChartCon. It's right around the corner, and 62% of those responding have not been to a ChartCon. I am shocked at that.
Well, I kind of am not, just because it used to be, in 2011, 12, and 14, you had to actually travel and show up in Seattle or wherever we happened to have the show. But in 2016, we went to that, format where you can do it online. And now we had way more able to attend. We had much more, amazingly, interaction with everybody who was there, because we had a lot of one-on-one time through the social apps, and just we have a lot of people coming this time too.
Yeah, I'm shocked. Even years when you had to travel, I mean, they could have had a face-to-face meeting with you. So
sure,
been there. But yeah, with the online, I mean, it's easy. And as I've said before, this is not a sales conference, which is, most of these traders expos and things you go to are very sales oriented. This is knowledge oriented. This is going to make difference in the way you look at the stock market, and the way you trade, and the way you manage risk. That's what this whole conference is about, managing risk, and how many technicians, very experienced technicians, leaders in the field. I mean, when you're talking about, I think John Murphy's might be joining Chip for his opening presentation. We got Martin Pring coming, all the huge list of names. I don't know why you wouldn't want to check this out. And especially with volatility index much higher this year, that has been a problem. Some of the things that Bruce and Roman were talking about earlier in the show, looking to try and get, are we going to get that confirmation on breakouts and so forth? So much information that so many people have to share at this conference. I have no idea. I'm begging you all to sign up, and I'm that truly from the bottom of my heart. I think it'll make a huge difference.
I don't think it's you'd regret it. And honestly, you don't have to be there during that time live, because you get to have the replays and the archive of it forever, which is why I want to make sure I'm ready for it, since everybody's going to have me on their hard drives for years.
Well, there's our upcoming schedule. I do want to mention that tonight after the bell, we do have Facebook, PayPal, Qualcomm, among many others. I think Gilead in the biotech space. I mean, the list goes on, but there are going to be a ton of earnings reports, to make sure that you are prepared for that after the bell today.
Absolutely.
All right. Well, thanks, Erin. Another great show. I want to thank Bruce and Roman for joining us. Just a fascinating session that they did with us today. Make sure you check out their show on Fridays, Power Charting at 3 p.m. Eastern. Want to thank everybody for being with us today. Please remember to complete the survey as you exit. We'd love to know what you think of the show, and especially what you thought of the power charting information. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. Hopefully see you back here tomorrow. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.